It is my pleasure to have Linda Duessel in our office today to offer her insights into the economy and the markets. Linda is a senior equity analyst for Federated Investments, a firm that manages over $361 billion of assets. So Linda, let's get started with our first question. So Linda, oil prices have come down dramatically since the Great Recession. It seems like oil drilling technology advancements have dramatically improved the ability to create more supply. Where do you see the short and long-term trends in oil prices, and how do you see that affecting the global economy?
Well, it's very tough to call where the price of oil will be because we're not sure if the price of oil is being driven by demand or supply issues. We do know that the United States is becoming ever more energy independent, and that is a really bullish thing. And to the extent that we continue to grow this business, it's hard to imagine a $40 to $50 price of oil going back to the 110, which is where we were back in the middle of 2014 before things started to come down. That's good news for us in the long term. Energy independence is good, and we would think and expect that as long as our economy continues to grow, no recession on the horizon as we believe, we could get up towards $60, maybe even $70. But the other important aspect that's very difficult is, what if China's going into recession and that's why the price of oil is down? That's the second biggest economy in the world, and if that's what's going on there could be pressure yet again on the price of oil. Very difficult to guess the long-term view, but in general, probably a sideways kind of a pattern in this mid to high $50 to $70 range, I think would be the best guess for an extended period of time.
So Linda, you brought up China. So I was in China earlier this year. In fact, I happened to be there in early January when the stock market corrected, largely due to the Chinese devaluation of their currency. China is becoming a major player in the global economy and the markets, as you've mentioned. Do you see China having a positive or negative effect on the U.S. economy over the next 10 plus years?
Well, China has quickly leapfrogged over every other country to become the second largest economy in the whole wide world. That has been excellent news for our country as well as others in terms of their exports. And that's a good thing. A growing economy is a good thing. They are trying to transition from being an export-led economy to a consumer-led economy. And that transition, particularly of a country of that size, is likely to be not necessarily smooth, which could cause reverberations around the globe. If they should slow into a recession, it could cause a global recession. I believe the United States is the strongest country if that were to occur, and we don't necessarily have to go into one. But in general, we believe that China and its continued growth will bring growth, particularly to emerging economies around it, and that their demand as their consumers become ever more desirous and able to buy the sorts of things that we own. It's great news for our economy as well as others. Continued growth is good.
Low interest rates have been a part of our lives since the Great Recession. Nearly a year ago, we finally had our first interest rate increase. How do you see the interest rate climate affecting mortgage and commercial loan rates specifically over the next near term?
Well, these rates will be based on the long-term interest rate, which is a function of the market's expectation for growth and for inflation. And we have said in these last number of years and continue to feel that you will be surprised as to how long interest rates stay low. I am not in the camp that believes that long-term interest rates will be rising much from here. In fact, Federated Investors believes that we are probably in the back half of this economic cycle. So that argues for a slowing of our economy, if ever so slowly. And that's not necessarily inflationary. So my view would be that interest rates in the long end to affect the mortgage and commercial markets will stay very friendly for quite some time.
The stock and bond markets have been on a nice upswing for several years now. Many people feel that valuations are stretched in both bond and stock markets. What is your opinion on the valuation of what areas of the market do you see may be particularly undervalued or unusually overvalued?
Well, truly, since we've come out of this terrible global economic recession, central banks all around the world really have been printing money. And when money gets printed and pushed out into the system, it always finds its way into financial assets. I can't argue that stocks are cheap, nor do I believe they're expensive right here, because there is no metric more closely tied to the appropriate price to pay for earnings than the level of inflation. Today, that level is low and positive. And as long as we don't see an economic recession on the horizon, which we don't for 1 to 3 more years, we think that the price, if a little expensive on stocks, is not too expensive. On the other hand, government bonds are extremely expensive by any historical measure. The price that we're paying for government bonds continues to go up as the yields continue to go down. And I think that's largely because of the fear of another financial crisis and people thinking they can't lose money in government bonds, and because of the lack of government bonds anywhere around the world of any yield at all makes ours looks pretty good. So we would suggest that the bond market, the government bond market, is expensive versus the stock market. Where we are in the cycle, we think high-quality dividend stocks, if not inexpensive, look reasonable, particularly as a way to augment income. And if we are truly on the back half of an elongated cycle, we kind of like technology stocks and possibly healthcare stocks, depending upon the politics.
Lastly, Linda, how do you see the upcoming election affecting the markets?
Well, the stock market, first and foremost, hates uncertainty. And it is currently priced for the expectation of a Clinton win. Hillary Clinton's been in the business for many, many years, arguably is a known quantity, and the market would be fine with a win there, particularly if it's in the context of a divided Congress. If, on the other hand, Trump were to win the election, the stock market is not prepared for that and has decided that there's a lot of uncertainty with regard to how he might conduct himself and policies that he might put forth. So that would argue for a pretty good pullback. Regardless, we believe that no matter what happens to the markets as the election unfolds, it is all noise, particularly on the short run. On the short run, the question we only need to ask ourselves is whether is there a recession on the horizon and we don't see it, and are stocks expensive and we don't see that they're too expensive. So if for any reason we saw the markets gyrate in the face of this election, we think that might be a good buying opportunity for stocks.
Linda, thank you for coming to Marquette and spending some time with us today. We really appreciate it.
Thank you.